Let's get to Rick Santelli. Rick.
Well, the first numbers to pop up are our June read on Empire, Gotham Manufacturing, and it's a bit of a disappointment. Expecting 22 and change, we end up with 17.4. That follows at least up to now an unrevised 24.3. On the retail sales side, down 1.3%. That's much worse than expected. However, we knew autos were going to be a distortion. So what we really want to do is, considering that the chip issue has really pushed off the inventory on the auto lots, we want to look at X autos. That hasn't cropped up yet. So X autos and gas is down 0.8, so a bit of an improvement, but also much worse than expected. Now, we'll go to the inflation numbers until the rest of retail sales propagate. PPI for the month of May expected up 0.5% is hotter, up 0.8%. Strip out the all-important food and energy, it's up 0.7, 0.2 hotter than expected. And ex-food, energy, and trade up 0.7 as well. All these are hotter than expected. Now, let's really get to the Moneyball numbers. The year over year. If we go final demand year over year, it's up 6.6. That's a new all-time high for the series dating back to November of 2010 in its current calculation form. And if we look at the year over year ex-food and energy, that's up 4.8, exactly as expected. And that usurps up 4.1, which is the highest going back to November of 2010. And the last of the year over year is PPI ex-food, energy, and trade year over year, 5.3. And yes, you guessed it, that's also a new high for this series. But this series only goes back actually to 2014. Okay, let's go back to retail sales, shall we? So we know the headline was minus 1.3. It should improve when you strip out autos because they were a bit of a drag. There's not a lot of inventory on the lots, and it did by almost half, but it's still down. It's down 0.7. This is where it was supposed to flip positive. And ex-autos and gas station sales, minus 0.8. So really, it's a miss on all cylinders with regard to retail sales, which means the control number is a minus 0.7. That gets plugged into other data points. So, Becky, hot on inflation, weak on Empire Manufacturing, weak on retail sales due to some glitches in the supply chain, and we see interest rates ticked up 1 basis point from 148 to 149 and change on 10-year note yields, and we lost our pre-opening positive Dow Jones. It's popped back a little bit, but we lost some of those points. Yeah, back to you.
Rick, if you take this whole picture, what does it mean to the Fed as they're sitting down to this two-day meeting?
Well, listen, to me, the Fed's the easiest call here. They have no idea where inflation's going to be down the road. The transient argument makes sense because this recession is unique. But, do you put all the chips on transient? If I was a trader, I'd be more like Paul Tudor Jones. I'd be a little leery of that. The Fed can't tell the future. Their prognostications in the past have been a D minus at best. So I think the Fed's going to stick with the current tail, and that tail is it's going to be transient, and they're going to err on the side of overstaying their welcome with regard to some crisis policies still in place, like the purchases of $120 billion a month combined of $80 billion treasuries, $40 billion on the mortgage backs.
Shepard Smith here. Thanks for watching CNBC on YouTube.